conversation with the pioneer of technical analysis in India, only on ET Now.
Hello and welcome to Talking Technicals, the show that helps you make your own trading decisions. And a very important part of a trading strategy is to let your profits run long and your losses cut short. And that's what we're going to try and understand today with the help of stop losses. Of course, our show expert, Dr. C.K.NARAYAN, is going to help us do all of that, understand the what, when and why of stop losses. Well, the fact that the market went against your forecast and something about your trade didn't go right, and to prevent losses from getting any deeper, say maybe 10% or 20% or even more, you just get out of the trade and watch the market from the sidelines till you're sure again whether you want to get in. So this is one way to use a stop loss, but of course there are other stop losses as well, like break-even stops, buying stops and trailing stops. So how do you stack all of these up? Let's put that question to Doc.
Let me illustrate that with, with a chart where, of course, like we say, a picture is worth 1,000 words. So here is a chart with a trade on. This is the Bank Nifty chart. Now I have put on this, let's say, resistance trend line as a kind of definer. So if you have, a breakout, this is where you would actually look to be trading long, right? This is the breakout from a trend line. So we have a buy signal. So the initial stop could be anywhere beneath the trend line, because the trend line is what has defined the buy point. So you can have it just beneath, you can have it below this bar, you can have it at this low, somewhere here. So let's say we want to be conservative and set it down to the low, right? Then the stock has a move. So as soon as the stock has a move in your favor, you can shift your stop loss up to where you actually purchase the stock. So from an initial stop, your stop loss now gets converted into what is known as a break-even stop. So that at this stage you don't really lose any money. And then the stock has more of a move. So then you can now move it to further swing lows here. So now, as you keep moving this out, this is what you get as what we call as a trailing stop. So there are three types of stops. One is the initial stop, then a break-even stop, wherein you don't lose money as soon as the stock moves in your favor. And then you trail the stop upward so that you protect some amount of the profit which is available.
Fair enough. All right, now there are many ways to set these stop losses, and of course chart stops is one way to do that. We will talk about that in just a bit, but there are other methods as well, such as the percentage stops or the equity stops. And what are these? Well, these are essentially set as a percentage of your portfolio value. So if you're looking at, say, 5% of your total portfolio value is all you want to lose. So if you have a portfolio worth 1 lakh rupees, your loss, the moment it reaches 5,000, that's when your position will be squared off, because you don't want losses higher than that. And often your broker actually will square off your trades if you cannot top off your margins in your account. So that's also another similar way of putting a stop. Then, of course, there are time stops. And time stops is where basically if your trade does not fructify in a given amount of time, then it's squared off. And this could be, say, at the end of day. It could be before trailing stops once those levels are crossed. So these are two ways in which you can look at limiting your downside as well as improving and protecting your upside. So, Doc, let's see these on the chart.
Yeah, let me show you the chart. See, the concept is very simple. Like you explained, it's a trend line. The trend line is used as a support resistance mechanism. Now, the same support resistance mechanism can be converted into setting of a stop. Now, if on the chart you see here, you have the Nifty trade, let's say, moving up over the last about 8 to 10 months. And there was this nice uptrend. And this nice uptrend was actually supported by a long-term trend line. Now this long-term trend line is support, but once that support gives way, then that is where you should actually be exiting. So the trend line, by its basic function of trying to define support and resistance, also sets up the stop loss level, saying that once the trend line is breached, the support level is breached, and therefore the upside trade or the long trade is no longer maybe viable for the future, which is why you should be exiting. So
one quick word here, Doc. The trend line, of course, keeps moving with time.
Yes.
So how do you keep resetting your stops as time progresses?
Well, you'll have to redraw the trend line as the moves go. Now, that will actually depend upon how aggressive you are. Like for example, on this chart, if I want to be a little more aggressive, then I could draw a trend line which is like this, that I don't want to give too much room for the market to breathe, because I'm now sitting on a lot of profit. So I could probably draw a steeper trend line. So trend lines can be drawn as soon as you have some swing lows or swing highs, right? So
But do these stops also change every day?
Yeah, because the slope of the trend line will ensure that the stop will be increasing every day in the direction of the trend. And that's exactly how it should be. If the market is going up, the stop should be increasing. and staying closer to the price.
So you have to clearly be monitoring your trades on a daily basis
Yes.
to know where your stops are.
Yes, or I mean, as far as the trend line is concerned, it's fairly simple. You know what is the slope of the trend line. Let's say it is 8 points a day. So for every passing day from the first value, you just keep on adding 8 points. So you don't have to look at a trend line every day as long as you know the slope.
You know what the amount is. All right, time for a short break. When we come back, some more advanced tools on chart stops. We look at the parabolic SAR. And if you're wondering what SAR stands for, we'll tell you when we come back.